Sometimes a single decision can change everything. Back in October of 1973, one of those decisions was made, and in just a few weeks it brought the most powerful nation on Earth to its knees, with its people literally begging for gasoline. This wasn't a war on American soil or some kind of natural disaster. No, this was a weapon made of black gold, and it taught us a terrifying new word, stagflation.
To really get how deeply this crisis cut, you have to understand what things were like just a couple of years before. In 1970, this was the average price for a gallon of gas in America, 36 cents. It was cheaper than a carton of milk. It was a time of what felt like just endless abundance, muscle cars, open highways. Nobody thought about fuel. I mean, why would you?
So how did we get from that world of cheap, endless energy to a nation of shuttered factories and gas lines that stretched for miles, seemingly overnight? Well, the answer is a story about a hidden weakness, a geopolitical powder keg, and an economic puzzle that absolutely baffled the world's sharpest minds.
Okay, so before we even get to the gas lines and the global politics, we have to talk about the strange disease that this oil shock unleashed. It was an economic condition that, according to all the textbooks at the time, simply was not supposed to exist.
The word they came up with was stagflation. It's a nightmare combination of stagnation and inflation. Now think about that for a second. It means the money in your pocket is worth less and less every single day, but at the exact same time, you can't find a job. You're being squeezed from both sides. There's no escape.
For decades, you see, economists had this simple rule of thumb called the Phillips curve. It basically worked like a seesaw. If unemployment went up, inflation went down. And if unemployment went down, inflation went up. Simple. Policymakers knew the playbook for that. But stagflation? Well, it broke the seesaw. Now what do? If you raise interest rates to fight inflation, you destroy jobs. But if you lower them to create jobs, inflation spirals out of control. It was a perfect trap.
So to understand how this trap was even set, we have to rewind a bit and look at what pulled the trigger. It wasn't a stock market crash or some kind of banking failure. No, it was something much more fundamental: the very flow of oil. Now, this is where things quietly start to fall apart. While America was living this high-octane dream, something was happening under the surface that almost no one paid attention to. The country's own oil wells, they were starting to peak. Domestic production hit its high point in 1970, and then it started to decline. But demand, it just kept going up. So to fill that growing gap, the U.S. had to import more and more and more oil, mostly from the Middle East, and this created a hidden dependency, a massive vulnerability that almost nobody saw coming. And then, in October 1973, that vulnerability was exploited. It all happened so fast. On October 6th, the Yom Kippur War breaks out. The U.S. rushes to support its ally, Israel, by airlifting military supplies. Well, the Arab world was watching, and they were furious. Just 11 days later, the Arab nations in OPEC made their move. They declared a full oil embargo. The tap was turned off. The effect was immediate, and it was absolutely catastrophic. I mean, look at these numbers. Before the embargo, a barrel of oil was about $3. By January of the next year, $12. That's a 400% jump in just a few months. Oil had been transformed from a simple commodity into a powerful weapon, and OPEC had just pulled the trigger. So, with the weapon fired, the consequences started to cascade through every single corner of American life. Those abstract numbers on a chart, they were about to become a harsh and chaotic reality for millions and millions of people. Let me just paint you a picture of what this actually felt like. Imagine waiting in your car for hours and a line of cars stretching for blocks, maybe even miles, just hoping to get some gas. Stations started rationing fuel based on whether your license plate ended in an odd or even number. Tempers flared, fights broke out, and then after all that waiting, you might finally get to the front, only to see a handwritten sign taped to the pump, "Sorry, no gas." This was the land of plenty, suddenly starved of the one thing that made it all run. And it went so much further than the gas station. To save fuel, the government imposed a national 55-mile-per-hour speed limit. Thermostats in federal buildings were locked. And in what was a really powerful symbolic move, even the White House turned off its Christmas lights. The symbol of American power was sitting in the dark, a perfect illustration of this new vulnerability.
So here's the part most people completely miss. The policymakers were trapped, not because they were incompetent, but because their tools were useless here. This wasn't a problem of low demand, which you can fix with stimulus. This was a supply shock. The fundamental ingredient of the entire economy, oil, was being choked off. You can't print more oil.
It was like they brought a fire hose to a grease fire. Everything they tried just made it worse.
So, after years of failed policies, years of this economic fever just raging on, it became clear something drastic had to be done. And it would fall to one man, a new leader at the Federal Reserve, who was willing to prescribe a medicine so harsh it threatened to kill the patient just to save it.
In 1979, in comes Paul Volcker. He was appointed chairman of the Fed, and he had one single obsessive mission: break the back of inflation no matter what the cost. He looked at the broken economy, and he decided that the only real way out was to induce a controlled crash. And his only weapon to do it was interest rates.
And he used that weapon with absolute brutal force. Volcker started jacking up interest rates relentlessly. By 1981, the main interest rate hit a peak of 20%. Just let that number sink in. 20%. Imagine trying to get a mortgage or a car loan or a business loan with rates that high. You just couldn't. And that was the whole point. It was economic shock therapy. It was designed to strangle the economy until inflation finally suffocated.
The pain was immediate, and it was immense. The country plunged into a brutal recession. Unemployment soared to levels not seen since the Great Depression. Factories shut down, farmers protested in the streets. But Volcker never blinked. And slowly, very slowly, it started to work. This shows the brutal trade-off he made. By 1983, inflation, which had been as high as 14%, was crushed down to just 3%. The fever was broken, but the cure left some very deep scars.
Eventually, the crisis of the 1970s did come to an end, but its legacy, that never went away. In fact, the shockwaves from that embargo, 50 years later, are still shaping our world in profound and often invisible ways. I mean, just think about it. The fuel efficiency standards on the car you drive today, they were born from this crisis. The Strategic Petroleum Reserve, that giant emergency stockpile of oil the U.S. keeps, a direct result of 1973. America's intense geopolitical focus on the Middle East, the first big government push for solar and wind, and that deep, nagging fear of inflation that still drives our economic policy, it all traces right back to this moment.
And if you think this is all just ancient history, take a look at the parallels to our own time. In the 2020s, we didn't have an oil embargo, but we did have supply chain shocks from a pandemic and a war. And the result? Soaring energy prices and spiking inflation. And the policy response from the Fed? You guessed it, aggressive interest rate hikes, just like Volcker. They say history doesn't repeat itself, but it sure does rhyme.
So the real lesson of 1973 isn't really about oil. It's about vulnerability. It's a painful reminder that the complex systems we all depend on are often so much more fragile than we think. Because the next crisis, it's not going to look like the last one. It's going to look harmless. It's going to look normal. It might even look profitable, right up until the moment it isn't.